Okay, so we're just going to go ahead and hop right into it, the market update for this time. So big news today, the Fed did hike the federal funds rate by 0.75%. So this is not mortgage interest rates. This is a totally different interest rate. This is the short-term interest rates banks use to lend money to each other. They would affect your home equity lines of credit that are based off of the prime rate. They would affect shorter term loans like auto loans. So this is not the same rate as the mortgage rates. Right now, they have a plan to hike the Fed funds rate in order to curb inflation. So when they do that, if the market perceives that the Fed is getting serious about curbing inflation, then the mortgage market, as far as the mortgage rates, would respond favorably. We would rally and the rates would get better, which means they would go down. So the Fed did do that today. So that was good for our market. It rebounded by a lot already since 2:30. So that's good news. Hopefully it stays that way. Will it? We don't know. We continue to watch the market every day. Inflation is the thing that affects mortgage rates. When the inflation rate is high, mortgage rates do not react favorably to that. So that means that they go up, which is not good for real estate or housing necessarily, because higher mortgage rates means higher payments for buyers. Okay, so they do plan to raise it again in July, and then they weren't sure about September, but now it's looking like they are sure about that. So that should be good for our mortgage rate market. Let's go back and cover some news that came out previously over the course of the past week. We did have a Zillow and Pulsenomics home price expectation survey come out. What they do is they survey 100 of the top economists in the United States. They actually surveyed 114 economists, top economists this time. So on average, economists are expecting 4.8% appreciation each year for the next 5 years. So from now, which is 2022, through 2026, this would equate to 26.4% cumulative appreciation over the 5 years, the next 5 years. So this data conveys that the sentiment on purchasing a home, while it is still difficult, the market's still tough out there. There's low inventory, still multiple offers in many cases, but it is still considered a solid financial investment for the foreseeable future. Just to give you a tangible example, if I bought a $300,000 home today, it would be worth roughly $380,000 5 years from today based on the projections of the appreciation. I don't think you would find a quicker way to create wealth like this in any other investment vehicle. You're accumulating wealth based on the value of your investment, which is your property. So it's that much higher. So that's about $80,000 in increased equity or wealth in 5 years. So that's pretty darn good. The Fed hikes we talked about earlier, they again, I just want to reiterate, they're doing this as an effort to try to destroy the demand side of our economy. So basically hiking us into a recession to get inflation under control. Recessions sound negative for some reasons, but as far as the housing market goes, recessions actually are pretty good for housing markets. Housing markets tend to stay solid. Interest rates tend to go down. So as far as our sector of the industry that we work in, it should be not bad if we are definitely going into recession. So that's what we should see with that. There was a poll that mortgage-backed securities, Highway, they have an index, and they polled real estate professionals, mortgage experts, those types of industry professionals. And here's what we're seeing on the graph. So professionals that are in the housing market, 91% of them are saying that the housing market is active to very active. As far as pricing pressure goes, 79% of them are saying that there's moderate to significant pricing pressure, which means that values of homes are stable and still rising. Just to cover our area here in the Mid-Atlantic, 87% of housing industry professionals are saying that the market is active to very active, and that 91% of these professionals are saying that in our area, the pricing pressure is moderate to significant. And we are seeing that, especially a couple of markets that I work in. Most are Newcastle County, Delaware, and Cecil County, Maryland. And we are seeing that very much so in Newcastle County, Delaware. Not quite as much in Cecil County. I tend to say that it's a little easier to buy a house in Cecil County than it is in Newcastle County. That's what I'm personally seeing. What's happening is, in many cases, we are still seeing multiple offers in many cases, but less multiple offers. So if we were seeing 12 offers on one house in the fall, maybe we're seeing 3 offers now. So that's kind of how the market is changing. We are expecting appreciation to slow and be more normalized. We consider normal to be about 3%, and we're still projecting that the appreciation year over year for the next 5 years, from 2022 to 2026, is still going to be about 5.8%. So it's still going to be a strong market. And on Friday, we got inflation numbers in. This is the report that mortgage interest rates respond very much to. So the consumer price index is measuring inflation. It was expected to go up 0.7% month over month. It went up a full 1% month over month. So it was higher than expected, which is bad for mortgage rates. So we did feel that on Friday, and then Monday, it was rough out there. Year over year, inflation is up 8.6%. That is a new 41-year high as far as that inflation figure goes. And it's a new high for this current cycle. As I was saying, this CPI report, which measures inflation, did cause some turmoil in the mortgage market. We did feel that. We saw rates go up very sharply in just 2 days. But then today, the Fed hiked the Fed funds rate, and now we're seeing what we call a rally, which means rates are probably going to look good tomorrow when the market opens up. The core rate of inflation, which strips out food and energy, month over month was 0.6% higher. It did go down just slightly year over year. So let's just discuss this chart for a second. The consumer price index for May of 2022. The headline, which is the CPI, again, the change was an increase in 8.6 year over year. The core rate year over year increased by 6%. Rents have increased by 5.2%. Food has gone up by 10% year over year. New cars are up 12.6%, and used cars are up 16.1%. So we are seeing some inflation, and we all know that. Not good for mortgage rates. So let's talk about cars for a second, because I have an interest in cars. The price of used cars have been inflated for some time. We see that the prices are up 16%. So what this comes down to is the whole supply and demand, as it always does when we're talking about inflation. The pipeline for used cars, how they create the pipeline for used cars in the future, is through people leasing their cars. So people have been leasing cars less than they were, and rental car companies would typically buy new cars for their fleets, and then they become used cars in the marketplace. So they're doing less of that. So the pipeline for used cars is low, which is driving prices up because demand is high, supply is low, prices are up. Fuel is up 17% month over month. It's up 107% year over year. We pretty much know that. The price at the pump pretty much across the board's at about 5% and higher in some places. Hotel costs are up 20% year over year. We're also seeing that the savings rate for Americans has decreased. It's now back down to pre-pandemic levels. It was at 34%, and it's currently back down to 4.4%, which is the lowest level of the savings rate for Americans since September of 2008, which was in the midst of the mortgage meltdown. I remember it very clearly. This is another sign of things slowing in the economy and in recessionary type indicators. One bright spot in this whole thing is housing. 38% of homeowners own their homes free and clear. So they own them, they don't have a mortgage, so they have all that equity, and the values are still rising. Refinances are down significantly due to the rise in mortgage rates. Half of all mortgages out there have an interest rate of less than 4%. So rates are higher than that now. So as refinances are really much lower than they had been in the previous 2 to 3 years. And a survey done by Bankrate does also support the fact that housing is a bright spot, because 74% of Gen Z and millennials still view homeownership as one of the top hallmarks to achieving the American dream. Homeownership came before things like retirement. 2/3 of individuals surveyed did state that what's keeping them from buying a home is affordability issues. So I do encourage you, if you can get approved, and if you're renting right now, but you can get approved to get a mortgage and buy a house, I would encourage you to do that. Get in now, because the prices are projected to still go up over the next 5 years. Rents are going to go up too, but you're not going to have anything to show for it at the end of the 5 years. If you're pretty much secure in a location and you want to be in that area, I do encourage you that if you can try to buy. You're going to be happy that you did when you look back 5 years from now, when you look back and see that you bought and you were able to capitalize on increased appreciation, building wealth, and you should make out pretty well with a home purchase. That's all I have for today, and I will see you next time.